everyone again for taking the time to be on the call today. So in our last webinar, if you were there, we discussed how to use premium financing as a tool for your wealthy clients. So this is a great concept, but we realized that it really is only relevant to a few of your clients. So as Michael mentioned, today we're going to focus on sales ideas that we think will apply to the bulk of your prospects and sales ideas that are useful to help you recognize and capitalize on opportunities that you'll encounter on a weekly basis. So as always, our goal today is to provide you with concepts that you can apply to growing your business. So I hope these are useful to you. So let's get into it. So we're calling this one Give Every Dollar a Job Description, because this really is going to look at several different categories of money that most of your clients are going to have and making sure that they're all being utilized in an efficient way. Okay, so what are those three categories of money? Very simply, we think there's three categories of money: the now money, the later money, and the never money. Okay, so why would we even go to the trouble of distinguishing these? Because we think that there's different opportunities in each different category. And by breaking it out like this, it makes it easier for you to recognize all the different opportunities that you may have with the client. So we're going to look at each one of these in turn, and we're going to look at some of the opportunities that we think are presented by them and how you can capitalize on them and help your clients. And then we'll talk about kind of how you can recognize and what kind of money your clients have in each one of these categories. Okay, so I'm hoping that you'll be able to take this right away and apply it into your business practice. First of all, we're going to look at now money. Okay, this is current spending. All right, and what is your challenge here? Your main challenge is going to be protecting this income stream for your client. Okay, this is your bread and butter, the basic life insurance sale. How am I going to protect my client's spouse and children if that breadwinner dies early? Okay, so pretty simple. I know you all do this. One tool I want you to use on a regular basis that I think is very useful is just a simple doing a capital needs analysis. Now, I know a lot of you are doing this, but some agents are not doing this, and I think that it really shows your client that you're doing a calculation for them, you're adding value, and you're really showing them what they need and why they need that much coverage. So here's the spreadsheet I put together that I use with my clients and I help agents with. It breaks down a client's needs into a few different categories. As you can see, lump sum needs, that's money they're going to need, today, right after a spouse dies. Income needs, that's going to be an ongoing replacement type of thing. And then there's, the assets they have right now, which are going to count against the amount of insurance they need, and then we can calculate what it is that they actually need, come up with a firm figure. Okay, so your lump sums are going to be final expenses, outstanding debts, maybe they have some car payment, something like that, their mortgage payment. Something that's often overlooked is, what about college funding? So in this case, we've said, yes, we're doing college funding. It's going to be public school. We're fine with that. We're going to send them to UGA. And, okay, we got 3 kids, and we can put their age in there. And this is actually going to affect your results, okay? So we're being very mathematical about how much money we need here. Income needs, very simply, we're going to take how much income they need to replace and how many years they want to provide it for. And then we're going to say, okay, well, inflation is constantly eroding, our buying power over time. So we're going to use that combined with what we think is a reasonable rate of return, and it's all going to calculate how much money we need to have after a spouse dies. Subtract out the money they've already got, and boom, comes out about $1.5 million for this client. One of the reasons I think this is so useful, and I found it personally useful with my clients, is that your clients tend to think, at least I've found, they'll think, well, $500,000. That's a lot of money. I don't have $500,000 in the bank. You have to convince them that $500,000 is not going to go very far in continuing their family's lifestyle. Okay, so this actually calculates a number for you, and you can show them, you really need 3 times that much. You really need $1.5 million. Okay, so we've convinced them through math that they actually need a lot more than they thought they did. So it leads to you protecting your client better, which is the ultimate goal, and it's also going to lead to a lot more commission for you. So overall, I think this is a great tool that you should use for everybody when you're talking about replacing income. Okay, feel free. I can send you my calculator. Also, there's a great one online, lifehappens.org. It has a lot of different stuff on it, but this is actually the link that takes you to the calculator. I can send you my slides if you want this, or you can just write down lifehappens.org, and that'll take you. You'll be able to find the calculator, no problem. Okay, this will take into account all the things that I just discussed above, and you can calculate it online, so it's very useful. All right, so that covers pretty basically the now category of money. We're going to get more in depth, I think, with the later and the never money. So with later money, we're really talking about your client's retirement savings. Okay, so I think for an insurance agent, there's really three main challenges your client has that you can help them face with insurance. Okay, there's the first one here. Your clients are challenged with creating an income stream for retirement. Now, I like to refer to it as creating an income stream rather than accumulating enough assets. Okay, most people tend to think of, I need to have enough money to retire on, so they're thinking about a figure in their head. But that figure could be drastically different as far as an income stream is concerned, depending on where you have your money. How's it going to be taxed? Where the tax rate's going to be? All that has a huge difference. So I want to focus on creating an income stream in retirement, not accumulating a certain dollar figure. Part of it's going to be a sufficient accumulation, but really where we can help them is optimizing the distribution of their assets in retirement. Okay? And what does that really lead to? That really means, for a big part, we're minimizing taxes. We're using leverage, but we're also minimizing taxes. So let's look at three primary sources of income, retirement income, that your clients are all going to have, or several of your clients are going to have at least one of these. Okay, for most people, the number one source is Social Security. This is a concern for several reasons. Your younger clients are going to be concerned about, is Social Security even going to be around when I retire, or is that program going to be pulled, or is it going to be only available when I'm 80? Some very legitimate concerns there. Also, depending on how you set up your client's income in retirement, what their adjusted gross income is, up to 85% of Social Security ends up being taxable. So if you're not really efficient with how you distribute income in retirement, you end up creating kind of a snowball effect and also getting Social Security taxed. Okay. Number two in the primary sources of income are traditional qualified plans, like your 401k, a traditional IRA. The problem with these, of course, is that 100% of the money coming out of them is taxable. So that's not very efficient. To compound the problem, this money coming out of here is added into your adjusted gross income, increases the chances of your Social Security being taxed. So bad snowball effect there. And the big thing when I'm talking about creating a retirement income stream is that if your money is all going to be taxed when you take it out in retirement, really what you're doing is you're going into a partnership with the government, and you're letting them decide how much money you're going to have in retirement, right? Because just because that money is being treated in a tax-deferred manner now, it doesn't mean that you have any idea how much money you're going to have, because the government can change what the tax rate is in retirement. Okay, so that's kind of a slippery slope. You might know how much money you're going to have approximately, but you don't know what it's going to mean for you as far as buying power. Okay, this opens an opportunity for you to talk to your client about a life insurance retirement plan. I've had several webinars on this. Feel free to reference some of those. We make all of them available on our website, or give me a call. I'm certain you have clients that could benefit from this concept, and I'll talk you through how it works. I'll get you an illustration. I can do a conference call with your client, explain to them how it works, all to make you the expert. Okay, I want you to be the expert on the phone with your client. So this is a huge opportunity I see here as far as minimizing taxes and optimizing an income stream for your client. Okay, another opportunity here, number three, a lot of people still have a pension as a major source of their retirement income. Less and less, but it still is there. A big opportunity for you is a pension max sale here. Okay, so basically this is your client is given the option of a single life income, which is going to be a greater amount, or they're given the option of a joint life income with their spouse, which is going to be a lesser amount, right? Now, what if we could take that greater income amount for the single life and still cover the spouse? So we buy a life insurance policy on the person who's getting the pension, and that amount is going to pay out to the spouse. And if that costs less than the difference between the two amounts, the joint life and the single life payout, then you've got serious leverage there. So you can give your client the assurance that their spouse is going to be taken care of, and they get to benefit from the greater amount of single life income. Okay, so that's a huge opportunity right there. If you've got any clients that are considering retirement, they're going to have a pension, give me a call and we can talk about it. I can do all the calculations for you and we can decide whether or not it makes sense for them. A lot of times it does. I can tell you if your client is insurable, there's a huge opportunity here. Okay. The life insurance retirement plan, I just wanted to give you a quick snapshot of numbers. Male age 45 puts $1,000 a month into one of these, generates $36,000 of tax-free income at 65. Okay, a lot of leverage there, not to mention this plan was self-completing because they had a death benefit. They had chronic illness to cover their long-term care needs. There's a lot of benefits wrapped up into this thing right here. And another nice thing about it, we were talking about taxation of your Social Security. This is not going to be included in your adjusted gross income. It's not going to be taxable, and it's not going to, so because of that, it's not going to increase taxation on your Social Security. Overall, this is very efficient. All right. Let's talk about the third way you can help your clients with this later money. So long-term care, healthcare costs. We're not going to talk about healthcare, it's beyond the scope of this, but your long-term care costs, this is something that can be a huge burden on your client's retirement funds. So this is very relevant to this later money right here. Okay. Some statistics here. 7 out of 10 people statistically that reach age 65 now are going to need some sort of long-term care during their lifetime. That's 70%. So there's a huge opportunity. Most of the people you meet are going to fall into this. If they've reached 65, they're going to need it. Right now, assisted living averages about $43,000 a year. Nursing homes, about $82,000 a year. So you can see most people are going to need it, and it's very expensive, okay? You can see the worst case scenario here is you have one spouse that goes into this situation and lives a long time in an assisted living facility and then spends some final days in a nursing home, and it really depletes the spouse's income. So that's really what we're worried about here. So why are your clients pushing back against this if you're having the conversation with them? You've probably heard this before. I don't need long-term care. I'm going to self-insure. I'm going to save the money. I'll have plenty of money. We'll pay for it. Really what they're thinking is, behind the scenes, that way I'll be much better off if I never need it, right? They're not really thinking they want to self-insure. Nobody wants to self-insure, right? Really what they're thinking is they can do something better with the money. Okay, so how do we get them beyond where they're thinking of long-term care as an expense, which most people will think of long-term care insurance as an expense, and think of it as an asset, okay? You ask them, why would you want to self-insure? Let me show you something that I can do for you, and then we'll talk about it. Okay, so how do we change it from an expense to an asset? Well, I think one of the main ways we can do it is with these new plans we have where we have a life insurance policy that's guaranteed that has a long-term care rider on it that turns the death benefit into a pool of money for long-term care if you need it. Okay, so this gets rid of that whole use it or lose it thing. If they don't ever use it, they're going to pass on a big tax-free lump sum to their beneficiaries, to their kids, to a charity, whatever they want. So now they have actually bought a pool of money that they're going to use in some capacity, we know for sure. Okay, it's no longer an expense. It's an asset they're either going to use later for long-term care or they're going to give it to somebody. Okay, so we've gotten rid of the use it or lose it. What are the numbers going to look like? What if, client, you give me $500 a month? It's not cheap, but let me show you what I can do for you. $500 a month. I'm going to give you and your spouse, for that amount of money, $7,300 a month each in long-term care. Yes, that's more than you need right now, but if we look at how much, the cost of care, it traditionally increases about 2 to 3%, very similar to inflation a year. By the time you're 70, statistically, this is the amount you're going to need by 70. So I'm going to build in some inflation here, $7,300 a month each. I'm also going to give you a death benefit of $730,000. You don't ever need that money, you can pass $730,000 on to your kids, okay? what's your worst case scenario as far as this plan? Okay, it's great for you, but as far as this plan, say you live to your life expectancy, you're doing great. That's wonderful. You never had a long-term care need. What did this plan look like? You still earned 5% at life expectancy on that $500 a month into the policy that bought you $730,000. Okay, so you didn't need all of this. The plan didn't pan out. You were correct. I was wrong. I protected you that whole time, but you also made 5%. So this was a great deal. So what if you went your self-insuring route? And let's say you went your self-insuring route and both of you needed some sort of long-term care by 70, all right? It would have cost you $1,000 a month to fund that, all right? $1,000 a month to fund it, and you would have had to earn 6% on that money. And by the time you're done, all that money is wiped out and you're not passing anything on to your children. So you can see I've cut your cost way down, and I've given you a benefit you're either going to pass on or use. So self-insuring mathematically does not make a whole lot of sense. So this is a huge value you can add to your client right here. I think you can change the conversation from an expense to an asset. I think that's the key. All right, that's the later money. Let's look at the never money. This is going to be money that your client has, maybe an old IRA from an old employer. They're going to pass this money on as inheritance, or they're going to give it to some sort of charity. Okay, what are the opportunities to help your client here? Well, I think there's several. I'm going to hit 4 of them briefly that I think will be a good opportunity for you. How do you optimize the transfer of your client's money? Say they have an old IRA. How do you transfer that? Is it better just to give it to your kids, or take RMDs and then pass the rest of it on, or what should you do with that? Okay, we'll look at that. Estate equalization. Now, your client doesn't have to be super wealthy for this to make sense. Okay, there's a lot of estate equalization scenarios that just your regular clients are going to be able to use. Make a lot of sense for them. Leveraged legacy. A lot of people want to leave money to their kids, even if they're not wealthy. They want to leave something, and life insurance can give them a lot of leverage to do that. And charitable giving. So we're going to look at all 4 of these as opportunities to help your client. So I think a good way to kind of open the conversation for optimizing a transfer of your client's assets is to give them 3 options. Okay? Put this in front of them and say, you have 3 options of where your money goes. You can cross one off the list, and you're going to give money to the other 2. Do you want to cross your family off, charity off, or the government? Which one would you like to get rid of? So I'm going to say that probably 100% of your clients, except for the ones that are joking with you, are going to cross the government off, right? And you say, great, well, that's what I help my clients with. I help them to optimize their transfer of their money to their family and their charity, which means cutting the government out. You've already given them plenty of money, right? Okay, so I think that's a good door opener to kind of say, this is what I do. This is what I do for my clients. This is how I help them. Would you be interested in looking at that? Great. Well, let's take a look at your IRA that you're not planning on using. You've already got other assets. You've said, this is some money that I accumulated a long time ago. It's kind of been sitting in that account. I want to give it to my kids. It's kind of going to be their inheritance. But I have other money I'm going to live on, Social Security, and some other accounts that I have. I'm going to live on that. I want to pass this on. Okay, so this client is age 60, let's say, has this money, not planning on using, not required to take RMDs yet. So this money is just kind of accumulating in there. He's not adding anything to it. All right. Strategy 1, which is probably what's going to happen if you don't say anything to your clients. This is what they're going to do. They're probably going to, they're going to take RMDs at 70 and on, right? So they're going to start taking that money out. It's going to get taxed. Probably they're going to take it out and give it to their kids after paying tax. And it's going to be kind of lifetime gifts they give them every year. It's great. And then at death, whatever's remaining in there, they'll probably pass on. It's going to get taxed at that time, and their kids will get whatever 60% of it, depending on what the tax bracket is at that time. So this works okay, but I would say maybe it's not the most efficient way to do it. So let's look at another option here. What if you start taking distributions now? We don't have to wait until it's time for your RMDs. You're in good health now. Why don't we start taking distributions? Statistically, income taxes are historically low. I know it doesn't feel like it, but historically they are. So let's take money out now while you're healthy. While taxes are low, we're going to lock in lower tax rates and buy a life insurance policy on you with the net amount from that RMD. We'll pay taxes, then we'll buy a permanent policy on you. We'll pass what's left on when you pass away of your account plus the death benefit to your kids. What will that look like? Well, strategy 1 is going to net $530,000 to the heirs. Pretty good. Strategy 2 with the life insurance gives them $700,000. Okay, so we have given them a 32% increase, assuming they live to life expectancy. It gets even better if they were to somehow, pass away early, something happens. And we've taken the risk out of the scenario. So this first strategy assumes they continue to earn money on their account. This one is already guaranteed. We've bought the life insurance, okay? We're just taking money out of the account and paying for it. So we've increased their legacy by a huge percentage and taken a lot of risk out of this thing. So with this planning, I think that life insurance makes a huge amount of sense for this client, and you've added a lot of value there. Okay, so that's one simple, optimizing the transfer of an IRA. What about estate equalization? Like I said, your client does not have to be wealthy to take advantage of this. You got a male and female age 50. They're in good health. They got 3 kids. They're not super wealthy, but they've done well. They have their main house will be paid for soon. They have a beach house that will be paid for by their retirement. Okay, we're just easy numbers. We're saying they're each worth $300,000. Okay, this is the majority of their assets. Okay, they've got retirement money to live on, but they don't really have a whole lot of other assets. So they're planning on passing these houses on to their children. Okay, you can see a lot of your clients will have some sort of situation like this. Maybe they just have a main house. Whatever it is, it works. Now, we don't want to pass these 2 houses on to 3 kids because what are they going to do? What's it going to look like in the following generation? Is this going to create discord? How are they going to deal with it? Are they going to sell it? Is everybody going to be happy? Now, I personally have seen that passing on property like this is not really a great way to do things, and it can lead to discord even in families you would think that it would not. So I would tell my clients, you need to find out some way to split this up. Now, if you want to keep this and pass these houses on to your kids, maybe you pass a house on to one, the beach house on to the other, and then what if you buy a survivorship policy on the 2 of you? You're both healthy. That will be $300,000, so you pass on $300,000 of cash to the 3rd kid. Each kid gets an equitable amount here, and you have split things up in a way that's not going to cause any sort of discord. So it works out well for everybody. And what is that going to cost you? These clients can do it for $1,850 a year, very cheap. Okay, they can take care of this big problem they have and pass everything on well, keep all the kids happy, and it's only costing them $150 a month. Okay, huge value you can add to your client. The 3rd one, leverage legacy. This one's simple. Okay, you've got a grandmother here. She's 70, standard health. She wants to leave $50,000 to each for 3 grandchildren. Well, great. Should she invest her money and leave it? Well, I mean, she's not really investment savvy. She doesn't really want to be in the market risking her money at this point because she can't afford to just lose it, so she wouldn't be able to leave anything to her kids. So what if we just buy her a guaranteed UL? She's still in standard health, which is good. For $365 a month, we can turn that into $150,000, $50,000 each for 3 grandchildren, guaranteed. Okay, what would she have had to earn on investment, assuming she dies at her life expectancy? She had to earn the equivalent of 8%. Okay, so this is a huge deal. We've guaranteed everything. We've put it in a manner that's very efficiently, from a legal and tax standpoint, going to pass on to kids, and we've given her a great return. Okay, I think this is kind of a home run, fairly simple conversation to have here. All right, charitable giving. Let's say you've got a client. We run into this pretty regularly with our agents. A client, male age 65, he gives $500 a month to his college that he graduated from. He wants to leave some sort of bigger legacy, though. Okay, so you talk to him, what if I could take that $500 a month and really make a bigger impact for your college? And he's like, well, I really like the tax deduction, though. Can we keep that? Well, let me talk to you about it. So have the college purchase a guaranteed UL on this guy's life. We can justify it from an underwriting perspective because this guy has been giving money. He has a history of giving money. All right? We have the college own the policy and be the beneficiary. Okay? This guy gives the college, keeps giving him the $500 a month like he always did, but it turns it into a leveraged amount of $275,000 because they use that money for the life insurance premium and they get $275 at his death. A huge benefit, big leverage. And he gets to maintain his tax deduction because the college is owning the policy. He's just continuing to give them money. He let them use a little bit of his insurability, and he gets to continue deducting that $500 a month. So overall, everything, all his goals have been met, and he gets to really leverage that gift. All right. So that pretty much covers the now, later, never. There's other opportunities. Those are some big ones. Now, so how do you uncover these opportunities? I would say that really you, and I know that a lot of you do this, really you ought to start with a fact finder with your clients, okay? Not just a conversation. Really, I want to write these things down and have a brief conversation with your client about this so that you can uncover opportunities. It's going to help you identify what your client's assets are. It's going to help you identify their priorities and their goals, okay? So if you have all of those things, you can really uncover the now, later, never money. So here's just quickly, and when you find out the different assets, you can ask your client the questions as you go through, okay, what do you plan to do with this one? What do you plan to do with this asset? And you just jot it down there, okay? Here's just a quick 2-page basic fact finder. You're going to find the information you need in order to run a quote. And then over here on the second page, you're going to find some really neat financial information where they've got all their money. And this is power right here. This is what you need to know. You need to know where that money is at, and then jot down next to it what they're planning to do with it, okay? And then also you can find out what kind of insurance they've got. Maybe you have an opportunity to replace it. It's a great opportunity there. Planning priorities. This is cool. You can find out what really they want to do. So just these 2 simple pages, and mainly this page, really give you the opportunity to open up these different sales, okay? So this is where I would start with the client. They might have an IRA here, and they say, you know what, I'm planning to leave that to my kids. What do you think? Well, I've got an opportunity. Maybe I can help this client to pass that more efficiently. Real estate. Okay, well, maybe I can do that. I can optimize the transfer to their kids by equalizing the estate with an insurance policy. Okay, I've got an opportunity there. CDs. Okay, here's one we didn't talk about. Maybe this money is not very efficient for them. Maybe we can put it into a policy with no surrender charges, give them some chronic and long-term care benefits and death benefits, and also keep that money accessible to them. Mutual funds, that's not very efficient. Maybe we can use the money that's going into this to fund a life insurance retirement plan. Pensions, okay, well, maybe I can do a pension max plan. All kinds of opportunities come immediately to mind in any of these things. So I think this is a great place to start. I can get you this fact finder, no problem. Just give me a call. I'll get that over to you. I think it's a great tool to start these conversations.
All right, Jake, thank you. If you've got questions, we've got the question box. If you will just click on the tab there, we're going to give a couple of minutes here for anybody with questions. If you would click on that and type it in, I will ask those to Jake, and we will give him a chance to answer. So we'll just give you a minute or two to ask any questions, and then we will wrap up. All right, well, we don't have any questions, Jake. Anybody that's listening, we would love to have you contact us. We would love to, any questions you've got, we can certainly answer offline. We thank you again for your attendance today. We want to remind you next month we've got a couple of different events, the Lunch and Learn and another webinar. Be on the lookout for that invitation, and thank you so much for your time today. Oh, now I do have a question. Let's see. So Jake, in the strategy 1 on optimizing the transfer, you mentioned the client being able to get $530,000 when they did it, when they self-funded it, and you improved it with the life insurance. How did you arrive at that number of $530,000?
Pretty simply, what I did was I calculated the client's life expectancy. I have a calculator for that, which I can also help you with that, by the way. And so I figured out they had, however many years to live based on their health, approximately. And I assumed that they had rebalanced their account to fairly conservative investments. They're earning about 5%. So what I did was I assumed in scenario 1 that they took the $250, left it where it was, and they continued to grow it at 5%, tax deferred. And then when they got to 70, I calculated what their RMDs were going to be every year. That's pretty simple. It's just a chart, so you can just put that into a spreadsheet. It's going to calculate what they would have to pay. I took into account taxes every year at 30%, okay? And then, so I assumed they gave the money every year as RMDs after tax to their kids, and their account balance was reduced by that. And then when they passed away, they passed that amount on to their kids, and it was taxed when it went to their kids. The combination of what they gave them during life and the taxed transfer at death was the $530,000.
Excellent. Okay. Thank you, Jake. Well, again, we certainly appreciate your time this morning. We look forward to helping with any of these opportunities that you're able to create, and let us know how we can help you. Thanks so much. Have a great day.